Today's session alone. We bring back Jim Rickards. He has been sitting beside me here listening as well to the CDC hearing. So, Jim, we were talking about lending, the effect that the Fed's QE programs have had on the markets. How much of this volatility is to blame directly on the Fed?
Almost all of it, because they made a mess of communications policy. You know, DJ, when you shoot at a moving target, you don't aim at the target. You have to lead a little bit, and then the target kind of flies into the bullet.
You sound like Wayne Gretzky.
Or maybe a Hunter. But what happened last week is the markets flew into a bullet that had been fired a year ago, which is deflation and depression. So for investors, I would say, let's look a year down the road. What are we going to get? We're going to get QE4. We're going to get helicopter money, probably in the form of tax cuts. At the end of the day, it has to be inflationary. Right now, deflation has us in the script. That's why markets are going down. Governments and central banks cannot tolerate deflation because it destroys tax revenues. And
it's essentially what's being seen in Europe right now.
Correct.
And that actually could affect U.S. investors, to your point, a year or two from now.
Right.
I mean, there will be deals shelved. There will be private equity firms that maybe put on the brakes a little bit to see how deflation pans out in Europe.
Right. I understand the deflationary dynamic. It's very strong, but central banks can't have it. We will get inflation, but how much money do they have to print? How do they have to do it to get there remains to be seen. Probably a lot.
Jim, come back when we can talk a bit more.
Thanks, DJ.
Very grateful in the meantime.